trying to provide you guys with content and just taking, just really wanting to lift the veil. There's really no secrets. We really just want to keep people properly informed and educated. As I mentioned, we just finished FranNet's semi-annual conference in the fall. This one was held virtually. And one of my favorite things to do after a conference is to connect with Blair and Charlie and just exchange, what did we learn and where do we think this is going and how can we support our clients with all this new information. And when I called Blair and Charlie and I said, hey, for this debrief, why don't we just open it up to anyone else that wants to be a fly on the wall and see what's happening in franchising as a whole, the effects of COVID, financing, where we think franchising is going. So as Blair's mentioned, this is the first time we've done this. So thank you everybody for joining us. And I really hope this is time well spent for you. So one of the key topics we thought that we would cover is the effects of COVID and franchising. So Blair, Charlie, anybody else wanted to, tee this up, or do you want me to take the lead on this one?
Sure. So yeah, I'll take the lead on it. So
okay.
Basically what we saw in franchising is what the general public saw as well, and just about any other business, is come the latter part of March, whether it's franchise sales or the franchisees themselves or franchisors, everything went on hold. Till probably about the latter part of April, we started to see franchisors start to open up their locations with their franchisees. It was very nice to see a good number of franchisors not only operationally support their franchisees along the way and continue to do so today, but a number of them helped them out financially out of the goodness of their heart, because they were all in this together financially, whether it be helping them with their PPP loans, whether it be freezing royalties, whether it be working with their landlords to get rent abatements, whatever the case may be. That was very good to see. And I think we've all seen, as we've gotten out there into the general public, unfortunately, the businesses that seem to be having a tough time have been the mom and pops, not necessarily the franchise that we see day in, day out. And that just goes to show you kind of the support and strength that franchisors have as compared to an independent business owner. Okay, so so that was kind of, I guess, good to see in a sense. Nobody likes to see anybody suffer,
right.
But at least the franchising industry has been pretty resilient through this.
Yeah.
What the businesses that we saw greatly affected were obviously those that had a personal touch, literally a tangible physical touch to it. Hair care, gyms, nail salons, massages, you name it, anything that had a strong personal physical touch to the customer, those probably had the rougher time compared to what we call essential services, which we'll go into here in a little bit. Having been through, so what I didn't mention to you guys is been with FranNet now approaching 25 years. So I've seen franchising go through multiple recessionary times. And what we see every single time this happens is that there's a sudden flip to whether it's recession resistant, COVID resistant, tech resistant, you name it, franchising and the types of franchise that people gravitate towards tend to be the ones that are resilient for that moment in time. Then we start to see another shift again. And my guess is literally come earlier this week, we're starting to see another shift. Okay, what I mean by that is prior to March, prior to COVID starting, we had a lot of clients looking at what we call semi-absentee. They were primarily semi-absentee in those businesses that got affected by COVID quite a bit. Again, hair care, boutique, gyms, you name it. And we're starting to see clients kind of raise their hand again saying, hey, now that AstraZeneca and Pfizer and these vaccines are starting to come out, not out in the marketplace yet, but hey, it seems like they're coming. I can still take advantage of all of the, call it discounts, if you will, of COVID. Right. Construction costs have come down, rental rates have come down, wages have come down. I can take advantage of all of that now I know I'm looking at an industry that's been highly affected by COVID and may still be for the next 6 to 9 months, maybe 6 to 12 months, but I'm not in business yet. So I think it's going to come back. I'll take advantage of all the discounts now. I'll pull the trigger on the business, but not physically open till, call it, second half of 2021, which nobody has a crystal ball, but theoretically, we should be turning the corner then. Will essential services still be a key part in franchising at that point? Yes, and they always have been. So we'll continue to see that. The other key components that COVID has had a big change on, which we'll get into and kind of call it other chapters of this conversation, are the trends and as well as financing as well.
Right.
So,
yeah, so we're kind of,
what we've seen clients gravitate towards, and I think, John, I've spoken to this with you, is, and Martin, I don't know if you, and I think you're working with Emily, I don't know if you guys started looking at businesses quite yet. Not quite yet. Okay.
not yet.
So these essential services, they tend to be, I guess for lack of a better term, what I've always called them is the ugly ducklings.
Yeah. Yeah.
And so they are businesses that, on the surface level are not pretty, they're not sexy, they're not glamorous, but they're essential. If you think about all the things that we've been doing as consumers over the past, call it 6 months or so, home improvement, construction, cleaning, commercial cleaning, all this stuff. That's what we're seeing happen right now. That's where our clients are gravitating towards.
And those are the
Blair,
oh, go ahead. Sorry, Veronica.
Blair, when you're talking about landlords working with franchisors, franchisees, are they working in terms of abatements or deferrals?
Both. And rental rates, or
Okay.
leasing rates.
Okay.
And their generosity with build out.
Yeah, right. I mean, it's a great time. It's a great time to open up a business right now.
Yeah, it's just, the unfortunate part, Veronica, is most of our clients who start with us have never been in business before.
Yeah.
Most people have never been in business before.
Mm-hmm.
Yet most people understand this, something like the stock market, and they know, hey, probably the best time to get into the stock market is when it is low, right?
Mm-hmm. Yeah.
Well, what's happening in businesses right now? It's low.
Mm-hmm. Yeah.
There's a lot of our clients don't realize it because they've never done this before.
Mm-hmm.
They don't,
Right.
I mean, I was talking to my financial advisor yesterday and we were talking about financing, and we were talking about home equity line of credit rates, and we'll get into financing here shortly. And we're saying, that the home equity line of credit rates haven't been this low since World War II.
Wow.
Yeah.
So,
I mean, look at mortgage rates.
yeah, that's what I'm talking about. I mean,
yeah,
it's crazy.
Yeah, it is.
So it's kind of the time. And so we've seen our clients be hesitant, but the ones that know that, hey, there is light at the end of the tunnel, it's starting to get brighter and brighter and brighter, those are our clients that are absolutely moving forward at full steam.
Mm-hmm.
I would say I was pleasantly surprised, and I keep jokingly using this word because it seems overused, at least after speaking with dozens and dozens of franchisors, but so many franchise brands being able to pivot within their systems. So for example, taking advantage of the summer months and offering fitness classes outdoors. I was amazed by the number of people that were able to do that, to provide fitness online, Zoom, to their consumers.
Mm-hmm.
And I'm going to let Ashley in here. And the number of members that kept paying their monthly membership dues for these online classes, speaking specifically to boutique fitness. Another thing that stood out to me was the number of franchises that had both B2B and B2C revenue streams, that when COVID hit, they went from predominantly being one to, in a matter of weeks, being predominantly the other. I think on that event that we did, gosh, just a month ago, when Michael Lee joined us, I think he's a great example of what happened with his fitness machine technicians business. And in terms of the number of mom and pops that closed, we don't want to capitalize on anyone's misfortune, but that did really increase the labor pool for other people looking to get into business as well. So those are some of my takeaways as well.
Yep. So let me just take a big step back, because some of you may be asking, well, how do you know all this? So again, like Emily said, we had our national meeting. Most of our clients talk to 3, 4, 5 different franchises. Well, within a period of a couple days, we spoke to 100 to 200 amongst the country, and kind of got the latest, greatest updates. I don't know, I don't have my little book, but maybe somebody does, of all the companies that we spoke to and gotten these updates from. So that's where we gained all this knowledge. So
yeah,
67 for me, it was 67 speed dates in 3 days.
Yeah.
Yep.
Across a broad range of categories and verticals and so forth. And I would second exactly what Emily and Blair are saying in terms of, I was impressed with the agility of the franchisors to make the adjustments needed, whether it was shifting from commercial focus to more consumer for those that have a blend. It also was a reminder to me of how nice and what a good risk management strategy it is to find concepts that have some diversification that serve the needs of both. And to Blair's point about those businesses that are essential, another way to phrase that is need-based. It's a little different context, but if it's not a luxury item, and it's something that a homeowner needs, for instance, well, there's some cover there. There's some risk management there. And what I found, not surprising, but it confirmed what I've been hearing all summer, is that the home service brands in particular have had a record year. It's crazy, the business that some of these guys are doing. And, this is not a trend, a post-COVID trend, but maybe a trend that's been building for a period of time and has really shown the benefits of strength. When you have these, these very fragmented categories that the majority of market share is held by independent mom and pop, often, not always, but often unsophisticated owners competing against these larger groups that through, very strategic consolidation over time are these large franchisors, sometimes owned by, multi-billion-dollar companies that have the resources to drive, for instance, marketing, during these tough times. And if you're a small local, in Marysville, Washington, home service business, helping people with their gutters or their, recovering the surface of their outdoor patios or building decks or keeping the grass green or, you name it, whatever that service might be. And you've got the marketing engine behind you of one of these, large groups. I went through, just to give you a little taste of it. I mean, right now, and from some of those speed dates that I had last week, Neighborly, 27 brands, Happy Nest, 9 different verticals, Outdoor Living Brands, 3, Belfour, 9, Home Franchise Concepts, 4, FranNet, 7, First Service Brands, 7, Premium Service Brands, 6 different ones. So when you not only have a franchisor to help you during tougher times, but then you also have a broader, bigger, the infrastructure and support and strength of these consolidated groups. Well, it's incredibly helpful. in general, but particularly during stressful times like this.
Mhm.
So the owners haven't had to sweat too much client acquisition. The marketing engine drives that, and then they can really focus on building out their teams and focus on fulfillment. So it's not surprising, I guess, to see that some of those brands in particular that are part of those larger ones really thrive. And to be fair to the other franchisors that have, that are heritage brands, they've been around for many years, they have not been acquired by a larger group, and they continue to build their brand and run their business. And we've got a number of them that have been franchising for 20, 30, 40, 50, 60 years. And they're doing well too. So it's part of the fun, I think, it reminds me of that part of what we do, Blair, Emily, and I, helping somebody say, well, do I want to be part of this big thing, or would I rather be, a member of the family, this kind of maybe a little bit smaller group, but, it's kind of different strokes for different folks.
And for Martin and John, Veronica, and Ashley, welcome. Ashley, I'm glad you were able to join us. A great example of what Charlie's talking about, he mentioned the parent company Neighborly, which has many brands underneath it. We actually have an event, I think it's December 1st, with Neighborly. And Neighborly has a number of brands like property management, restoration, cleaning services, electric, painting. Charlie, how many brands did you say they had underneath them? 27. Yeah. So what we're doing an event with Neighborly, the parent company, and they're going to feature some of their individual brands. And so you guys will be able to hear straight from the horse's mouth, if you will, about each examples of specific brands and the advantages of being underneath a larger umbrella company with cross referrals, marketing power, et cetera. So save the date, mark your calendars. We'll be sending out the link to that very soon, I'm sure.
What would that be? It'd be like a flock of ugly duckling brands?
Flock of ugly ducklings, there you go. It ain't pretty, but you can take them to the bank, Martin, John, Ashley, do you guys have any questions or anything, at least what we've covered so far? Jump in and interrupt or join whatever you want to do. All right, so shall we move on to financing?
Sure.
Yeah, there was a tremendous amount of talk about financing.
A lot to talk about. All right, Charlie, you want to take the lead on financing?
Yeah, sure. I mean, I think what I heard from a lending perspective is that, the good solid deals, good solid candidates that were getting qualified and getting loans in 2019, well, they're getting them in 2022. So if you've got a strong credit score, over 700, if you've got a liquidity where you're post-closing liquidity, in other words, after the loan funds, the money that you will still have in liquid reserves is sufficient, and you've got when those things are true, the deal's getting done. The lesson for 2020 is that those candidates and those deals that, there's kind of a missing kink in the chain. Maybe the candidate doesn't really have their relevant experience for the business that they're considering, maybe kind of a stretch. Or maybe it's a category that, unlike the essential services that we talked about, maybe it's had a little tougher time in 2020. Then the bank is, it's kind of like you got to give the bank something, right? If you don't have great liquidity, credit over 700, relevant experience, and a good solid franchise concept that's got a good track record. If one of those pieces is missing, then you need to kind of bulk up on some of the other ones. I heard, the thing with the credit score is, it seems from what I'm hearing, 700 is kind of the new number. it was 680. Now it's kind of 700, and 700 kind of gets you into the party. Now once let's say you got a 700, let's say Emily has a 800 and I have a 700. Well, we're both going to be invited to the party. Now, Emily's got the 800, but let's say she's got 30 grand in post-closing liquidity, and I've got 100 grand. Well, the banks are going to ask me to dance before they ask Emily. I mean, we're both in the party now. So as long as you've got that credit, and the traditional, SBA 7A loan, it's still out there, but it's taking longer. In pre-COVID, maybe it was a 3-4 month deal. It could easily be 6 months now. And so people are kind of starting to think, all right, what are some of the other options? There's another 7A loan called an express loan, which is for $150,000 and less. People generally think of it as a working capital loan because you can't spend more than 10% of the loan on build out. So if you're doing a location-based, inbound retail type model, it may not be the right product for you. But here's a little twist on that. Let's say that, sometimes I had a client this week that I spoke with who does not want to collateralize his house for a 7A loan. Kind of under any circumstances, but yet he wants to consider, these other businesses. Well, money is inexpensive right now. You mentioned mortgage rates and interest rates, and they will go up at some point, but right now it's like money's pretty cheap. So people want to leverage as much as they can, but they don't want to collateralize their house. So sometimes if they're doing a location-based business, they'll put the money in themselves. They'll self-fund the build out, but then use that working capital loan for working capital. And they don't have to collateralize their house, and it still takes a little time. You got to jump through some of the same hoops, but it's without collateral. So that's an option people are taking. And then the last one I'll mention is, which we haven't heard as much, and the ROBS program, I have to say, the ROBS, the rollover for a business startup, continues to have all the same benefits that it's ever had. It's not a loan. You're investing some of your retirement savings from a former employer to start a business, and it's not a taxable event and so forth. So that's been a major driver of franchise funding for many years and continues to be. But the one that's also proving to be useful during this time in particular are portfolio loans, or a security-backed line of credit. It's kind of two ways of saying the same thing. And it doesn't matter what your credit score is. You're not collateralizing your house. They're pretty inexpensive. And it's a line of credit. So you can use kind of as much as you need to, but not more than you need to. You need a $75,000 or more balance in a stock portfolio. And you can generally do that directly through your financial advisor. We work with some funding partners that can provide more kind of education and interest about, education about it. But that can be a great way to fund a business if some of those other limitations are there. So
I think, Charlie, kind of the pecking order as far as order of preference that we heard from the financing companies, assuming you have the ability and worth to do it, would be quickest, easiest, cheapest source of financing if you can do it.
Yeah.
Home equity line of credit. I think I heard that. 2 would be either ROBS or the portfolio backed loan. Then the express loan if you're within the limits, and then lastly your general, what most people call an SBA business loan. That would be kind of the pecking order if you're going to do it.
It would. And I think that the other thing just to throw in there is if you're in career transition, so you don't currently have your household income, maybe you've got a severance or maybe you don't, then it's going to be, okay, well, where is the other household income coming from? And so some clients are reluctant to want to put a spouse, tie them to the loan in any way. So that's going to be another kind of a dial or a factor in determining what's the right strategy, for you. So just like finding the right business, finding the right funding strategy is key.
Yeah.
And I think the other thing that they mentioned, I'm sorry, Emily, go ahead.
Oh, I was just going to say that compared to years past, what a key takeaway for me is that we need to start identifying our financing strategy fairly early in the game in the research process. So it used to be, we spend step one, we speak with franchisors. If we move on to step two, we start talking to franchisees. And then if we think we're serious, then maybe figure out our financing strategy. Now that's moved way up in terms of priorities. The other thing, and everyone, you may see Blair and Charlie, wish I had mentioned this later, but nobody's mentioned the Rainmaker Advantage plan program. Anybody want to tackle that?
The deferred taxes one?
Yeah.
I haven't had a client do it yet, but they said.
I haven't either. I took copious notes, which I would need to read because of the complexity of it. But can anyone describe that in a nutshell?
Well, Charlie probably took the best notes. So.
Charlie, I can take a stab at it, but I'm guessing Charlie took better notes than I did.
It's a very, very cool program.
Yeah.
For those that don't want to pay taxes on the sale of their business.
Right.
Now that sounds weird, right? Like, wait a minute, I don't have to pay taxes on this capital gains.
Right.
It is, I don't know what you want to call it. It is
I'm going to pull up my notes.
IRS ability, if you will. There's certain triggers that have to be, certain handles that have to be pulled to do it, but it's really gotten the interest of financial planners, of them saying, hey, you might be way better off of, instead of investing this money in the stock market, investing it in a business. Not only can you get the income from the business, but then you can sell this asset and not pay any taxes on it.
Yeah.
Is it an exchange for another business?
This is where the
right. I will say this really strategic financing program came from the same company that brought us the ROBS, the 401k rollover program in the 70s. So the notes I have, which might get us a little in the weeds. So say, this is great for a candidate that can pay cash for the business. So obviously not a lot of people are going to qualify for this. This is for someone who can pay cash for the business. And what they can do is use a small amount of their retirement funds for a new Roth IRA. And then they just pay the tax conversion. The money in the Roth will purchase common stock of the business into Class B shares that are redeemable at par value at the time of sale. Then you move, at the time of sale, you move the proceeds into the Roth, which can grow tax-free and can be utilized after 5 years and after the age of 59. And this takes place in a stock sale. I understand half of what I just said.
Yeah.
But the good news is we know people who know this in and out. So if Martin, John, Ashley, anyone is kind of thinking mental note, I want to learn more about that, Blair, Charlie, and I can introduce you to someone who can speak to it with intelligence and confidence. But it is a unique financing strategy. It's pretty new. Oh, Martin, I think you're talking, but you're muted. Martin, try again.
Okay.
There you go.
Thank you. Sorry. Yesterday, I was watching one of your videos, and one person, I am trying to remember the title of the video, but honestly, I cannot. And they were talking about that method that say, hey, how you get some money from, you put cash, let's say, and then you get this conversion from your 401k, then you grow the business, sell the business, and you move the money to the Roth program, right? There is a video that interesting. Again, I need to watch again to understand better, but looks very simple. I was telling this to my wife last night, saying, hey, you know what? This method could be nice because you can develop a business, and when you are ready to retire, you can sell the business in this way, and then basically you get tax-free money. Because I think that you pay some tax, but it's very small. This person was saying like 5%. That is nothing compared to the 25-30% that you usually pay, right? So it's a very interesting program.
Yeah, it's a way of saving, you know, hopefully hundreds of thousands of dollars in the future. So
all right. Veronica.
One other thing that it has to do with financing and loans and so forth, and I have found this to be so true, and I work with my clients on this, writing a good business plan from the standpoint of the person that is the franchisee, and even with the SBA, and I work closely with the SBA, and we're in the same office, and you know, I talk to the lenders there, and what they want for a business plan is sometimes a little over the top, but I work with this fellow in my office, and I'm not a business plan writer, but I know the elements of a business plan. He was the commercial lender for US Bank. So we pair up with our clients and try to explain to the people that if you can sell an SBA-backed lender on your idea and back it up by the franchise agreement and back it up by your experience or finances, your chances of getting that loan are so much better than if you don't have writing skills and you've got a credit score of 575. And you'd be surprised at the credit scores that I see. And I remember when I was doing leasing, it was like 525 and you want to open a business. How's that going to happen? You know? But if you can write a really good business plan and sell the person that you're presenting that business plan to on your idea and how you're going to make this grow. So many of the clients will, especially when they're doing financials, they put in these exorbitant salaries under employee salaries category. And I'm like, you really think you're going to make $50,000 or $60,000 the first year? What if I said, don't put anything in there for 18 months? And they freak out. I've got to earn something. And I say, yes, you do. But, you know, let's not put in $50,000 or $60,000. Let's use a very realistic number.
Right, that's correct.
Yeah. Thanks.
I would just second, Emily, what you, the point you made about doing it early. It's like, you know, getting pre-qualified for a mortgage so you know what neighborhoods to go look for a house in. You know, it's like first things first. It'd be a shame to spend a lot of time deliberating over, you know, this business or that business only to find that, you know, there's not a, you know, the strategies that are available to you based on your personal balance sheet are more limited. So
I'm generally starting it with my clients about, call it 2 to 3 weeks into the process right now.
Yeah. And if I have some that are just kind of on the fritz of you know, not sure what they'll qualify for, I've got them talking to our financing partners right out of the gate.
Right.
You know, you can look at someone's numbers and say, okay, they're going to have options. You know, this one's like, let's make sure we have options before we get too far.
Right.
Yeah.
Good.
Anything else on financing?
Those were the things I took away.
Okay. So another thing I'd like to talk about, and Blair, I'm actually, because you've been doing this for 25 years, I look forward to hearing to your thoughts, especially. Of course, Charlie, I always welcome your thoughts. Regarding where do we see franchise going? Granted, we've never seen anything like COVID, but we have seen certain industries and certain businesses come out really strong on the other side of an economic downturn. For example, when one of the franchisors that I met with is one of the largest, hair care companies in the nation. And in 2008, 2009, and 2010, they were opening 75 to 100 stores every year during that recession. Now, granted, don't know how that's going to look during COVID. I understand like staffing tends to be a great industry coming out of this type of economic turn. Blair, would you have any thoughts on either what I just said or additional thoughts on what we can perhaps predict based on what we've seen in the past?
This one is so different compared to what we've seen in the past because nobody saw it coming. In other words, it was a self-inflicted wound that we're trying to heal right now and will get healed. So this is a recession like we've never gone through before. Yeah. What I think will change, and I think we saw from the franchisors last week, which is actually very cool, and it makes it easier for business owners, is more the technology side of these businesses, is they have amped up their tech platforms for not only for the customers for ease of use to use the services of the business, but also from an owner's perspective of managing the business. So a lot of these businesses now, you can check the status of your business at any time on your cell phone. You can see, they were showing us examples of, I can see exactly what employees are in there, how much revenue we've done for the day, what's booked for tomorrow, the efficiency of my marketing to the day, everything directly from their cell phone. And you can do that from anywhere on planet Earth. So the owner doesn't necessarily have to be in there. For a lot of these businesses, there are a lot of businesses where the owner does need to be in there, but I think it's more of a technology play than anything. Which I think kind of what I mentioned earlier at the beginning of this conversation as to what types of businesses are going to continue to thrive. I think I kind of went over that, and I think we'll see another shift. But that would be my 2 cents on it.
No, I totally agree. And some of these, even these ugly duckling businesses, not only is the technology platform really sophisticated for the owners, but for the consumer, they've kind of Uberized it, if you will. So for example, if I've got a crew of technicians coming to my house to clean up water damage, I as a consumer am able to see who's coming, when they're on their way. I can track them, which I think is great for consumers, because usually people are like, well, we're just lucky if the contractor shows up today, let alone in the window of time they said. So, I really like that. And honestly, as a woman who normally my husband would be working out of the house and my child would be at school, I personally find comfort and safety in seeing who's coming, where they are, when they're going to get here. It just gives me as a user, a consumer, a sense of security. So even those ugly ducklings, I think, have provided some pretty sophisticated technology, just like what you were saying. Yeah.
So I think
absolutely.
It's technology, and what's different about this time, this recession, whatever you want to call it, is that it's not necessary. It's a pseudo financial recession. We've seen housing prices go up. The stock market is it's down, but close to an all-time high. So people are still feeling wealth. Granted, there are a lot of people without traditional jobs right now too. So it's a very weird one, what's happening right now. And like I said, it's more of a self-inflicted wound. We could probably jump out of this thing within 2 to 3 months. We all got our butts together and got our butts in gear and figured this out. But it's, we continue to delay it. I don't know.
I think
it's complicated.
I'd tag onto that to just say that it's accelerating some of the macro elements that have been present in the economy and growing for a while. You know, the people that are in the lowest quartile of the economy, which are service workers, I mean, they're getting hit the hardest for sure. And once, I mean, not all the businesses are going to reopen, particularly in hospitality and in food and so forth. And, you know, where will that part of our workforce go? You know, that's a challenging, that's been a challenging element for, you know, for a while. The other the other 75% of the workforce, you know, has adjusted to COVID realities. People are Zooming, working from home and so forth. But the recession that Blair talked about, it will cause some contraction. And with that kind of ongoing trend of, you know, artificial intelligence and machine learning and all of the various functions within business, which are being streamlined and automated, is going to continue to create efficiencies for companies, but that means dislocation for some workers. You're not going to need as many people in payroll. You're not going to need as many people in tech support, you know. And so for those mid-career professionals who then find themselves displaced, there could be fewer options for them in the corporate world to go to. And so for the businesses that franchising has always kind of held its hat on, essential services, all some of the things that we've talked about that are, you know, Amazon proof. You know, we always used to say recession resistant. Pandemic resistant was a term that was used in franchising, but I can promise you it will be going forward. I mean, that'll be a consideration that we all have. And so my point is, I think that the future of franchising is going to partly be driven by continued demand by largely mid-career professionals who need a solid stepping stone for their career path. And so I feel grateful to be in a business that's going to help serve the needs of those people.
The only other trend that I think we've noticed here in the Pacific Northwest at the franchisors, chatted with Charlie, Emily, and I quite a bit, and I don't, John, I know you're in Portland. Martin, you're in Portland, I think. I don't know where Ashley's from, but for what it's worth, Salem, okay. So it wouldn't affect anybody on this call, but the franchisors are absolutely salivating to get into cities like Boise, into towns where Emily and I sit right now, which is in Bend, Oregon, where a lot of people from the bigger cities are moving to at record paces. And so the franchisor is saying, whatever we can do to get into those cities, that's where we want to be. But it doesn't affect anybody on this call.
In Spokane, same thing. People want to move out of the Puget Sound area, go to the Tri-Cities, go to Spokane. Home prices in Spokane are just, you know, there's no inventory. There's just tons of people moving in there. So I second that.
That's a great point, because there's still great territory, large territories available for things that may be sold out in the larger metropolitan areas. All right.
Good. I think those were the main topics, right, Emily, Charlie?
Yeah, those are the things that we wanted to hit on. Any questions or thoughts?
We allotted about another 10 minutes till 1 o'clock. So any questions from anybody that we can try to answer for you?
Yeah.
Going once.
Not from my side. The only thing that I will ask to Emily, I am working with her in analyzing franchises, is even though I am living today in Beaverton, Oregon, so Portland metro area, I am not close to analyze something outside it here, right? I mentioned to you in an email that Washington, Oregon, and I say states, right? So at the end, if something clicks me, and the opportunities, as they were saying, it's in bend or is I don't know, making this up, core values, whatever.
Yeah.
I am open-minded, right? So
Okay.
at the end of the day, it's a balance of factors, right? So I just want to say that, Emily. So and we can talk about this later. But I think that's a very good point, right? There are the big metropolitan areas could be saturated right now in some key franchises that potentially can click on me. So if I want to take advantage of those franchises, I need to move to another area. Again, open to analyze that. Yeah.
Okay.
Thank you.
That's good to know. That'll definitely be something that we discuss when we start honing in on specific recommendations. Yeah.
A good point.
Yeah.
Anything else, group?
I just want to say, like, Martin, thank you so much for your feedback on our YouTube channel. You know, it's still a work in progress, and we're constantly trying to add to it. But the sole purpose of that channel was to provide people an opportunity to access on-demand content that was relevant and of interest to them. So I'm really glad that you found that helpful. Thank you for your feedback.
The only thing I will ask is in the commentary, if you can put some kind of bookmarks saying, hey, at this time, this franchise will talk, at this time, this franchise will talk. And I am saying this because I have watched a couple of videos twice, and then I go, okay, where is this franchise speaking or showing their content, right? And I need to move around the video because I don't remember, right?
Yeah.
So having that in the description, again, I think for people that like me is watching 2 or 3 times the videos, can help to nail the presentation that they want to hear, right? And also helps you because if you share this to other people, you can say, hey, if you're interested to this franchise, you can start getting some information in this video and this time frame, right? Whatever. Yeah.
Yeah. So
but they're really good content, honestly. Yeah.
Oh, good. So in the description, to possibly provide a timestamp as to they'll start talking about this at 3 minutes, 40 seconds. Would that kind of thing be helpful? Okay, that's good to know. Thank you. That's really helpful. Yeah, because we respect your time and want you to use your time wisely for you. Good to know.
Yeah, and I was thinking on that a few minutes ago. I was looking in the video about the Rainmaker. I found it. It's a video that you posted in July 30th. And the specific topic starts at 1 hour, 15 minute mark. And again, I think it's worth to watch that segment because it's very interesting. I know it's more complex than what the person is showing in the presentation, but again, as start understanding the concept, I think it's a very good presentation.
Yeah, and for us, Martin, the next step might be for me to connect you to have a one-on-one conversation with them so that you don't need to refer back to the recordings. We could talk about that. Yeah.
Yeah, sure.
Okay. Excellent.
Well, thanks, guys.
Yeah, thank you. Thank you. Hopefully this was helpful. Again, it's a format that we've never done before.
Yeah.
So we thought, hey, let's throw it out there and see what happens. So
It
absolutely.
was very informative.
Good. Veronica, thank you so much for joining us and contributing as well. It was great to have you.
Thank you.
Good luck, everybody.
And I'm going to finish my cookie now.
Yeah.
All right, Ashley, John, Martin, thank you so much, everybody. Have a great rest of your day.
Thank
Thanks,
you.
everybody.
Okay, bye, everybody.
Bye.
Bye-bye.
Bye-bye.